I was intrigued with this term that you guys have, which is the novel family office, And then I showed up to the actual office, and it's probably the most diverse group of people you've seen. And I'm like, these guys can't all be from the same family, can they? Welcome to Tech Money Smarts with Novel Wealth. Guys, welcome to the show. It's great to see you again. What about ESPP plans? Can you talk a little bit about that? What are the implications that we should watch out for there?
Yeah, absolutely. So ESPPs are a great mechanism that a lot of companies are offering, and the acronym stands for Employee Stock Purchase Plan.
Right.
And it allows for employees to purchase shares of their company, which is typically at a discount, 5, 10, 15, 20%, depending on what the program might be offering at work.
Okay.
Now, by buying these shares through that discount, the discounted portion is actually going to be a taxable benefit to the employee. So if you have a 15% discount on the stock purchase price, that 15% value is going to show up on your T4, just like that RRSU income might show up.
Right.
But nonetheless, it's effectively free money, right? The value of that share doesn't change despite the fact that you were able to acquire it at a discount. So by buying in and getting that 10, 15, 20% savings on the purchase price, that's income in your pocket on day one.
Degree of complexity, that's why we need you guys, right, to help us through all of that. All right, so another question that comes to mind. We see in the Canadian tech scene, the big American companies, and often we're getting employees move from Canada down to the US, down to San Francisco or wherever it happens to be. So a question that I know comes up is about RRSPs. What happens to your group RRSP when you leave a company or you get transferred down to the States?
Yeah, well, if you leave a company and you maintain residency in Canada, it's very simple. Your group RRSP just transfers into your individual RRSP. All right, so it's really quite simple there. I mean, as soon as you leave a company, the group RRSP you were a part of, you get booted out of that environment or out of that plan, so to speak, and you get moved into like a catch-all higher fee environment. So if you're like with a Sun Life or a Manulife or a Canada Life, and you leave your company, that low fee you were getting in your group RRSP now becomes a high fee. So immediately you want to get that out of there and transfer it into your individual RRSP. That cleans that up really nicely.
But that's something that a lot of people are not aware of.
No, I mean, we run into it all the time where people have left a company and they've been gone for many years, but they've got a RRSP left over at Canada Life, Sun Life, Manulife, etc. And they've been paying high taxes just because they don't realize that that's what they're subject to. Like
a zombie RRSP.
Yeah, there's a lot of drag on it for sure.
So what happens now if I get transferred down to the States?
Yeah, I mean, so then you're starting to think about, what does it look like to leave Canada and what happens to your assets when you leave Canada? If you leave Canada and you become a resident of another country, you get into a whole new ball of wax, right? So now you're talking about exit tax and how that exit tax is treated. You can still have an RRSP living down in the States. It's just if you're leaving Canada, the government's going to want its cut of your portfolio. And so that's where you really want to be working with an accountant to make sure that whatever that exit tax is, you're doing as much as you can to mitigate it.
Absolutely. It's a very complex, and each individual case can often be different.
Right.
So,
but what happens if you're just going down for you got a 2-year contract? That happens a lot, 18 months going down to the head office. What's the implications to you? Because now you're down there are you dealing with Uncle Sam down there?
Often you can be. Again, each scenario will be a little bit different, but if you're earning U.S. source income, if you're going to remain a Canadian tax resident, you still have to file your Canadian taxes, but now you might be subject to U.S. tax compliance as well.
Right.
So again, every situation's a little bit different, and you should definitely consult an advisor.
When I was originally looking at you guys, because I am a client here at Novel Wealth, I was intrigued with this term that you guys have, which is the novel family office, And then I showed up to the actual office, and it's probably the most diverse group of people you've seen. And I'm like, these guys can't all be from the same family, can they? So what exactly is a novel family office, and why is it of interest to, say, tech professional?
A family office is a concept that's typically reserved for the uber wealthy.
Okay.
And what it is effectively a team of dedicated professionals that focus on a single family or multiple families at once, but all the financial aspects that may go into their individual circumstance. So whether it's investment advisory, whether it's insurance and risk planning, whether it's tax and accounting, whether it's your lending or banking needs, it's making sure that there is a team that is working together so that the advice that's being provided is synergistic. You're not going to end up with conflicting advice from differing professionals because they aren't sitting around the same table having the same conversations in all aspects of that plan.
What other benefits are there to the family office?
Well, it's an opportunity opportunity cost thing, right? Like if you've got a wealth advisor who's separate from your accountant, who's separate from your mortgage broker and your insurance broker, you know, all those people are working on your behalf and are doing what they believe is in your best interest in a vacuum.
Right.
But the left hand doesn't necessarily know what the right hand is doing there. And so all those professionals aren't necessarily pulling in the wrong direction through no fault of their own, but you just don't have that coordination. So it takes time and energy to make sure that you're coordinating that team, which is a massive opportunity cost. Whereas if you're working with a team and all of that is managed in-house by the same company, it's one phone call, the left hand always knows what the right hand is doing, and you don't have to worry about coordinating any of that because it just happens inherently across the team that you're working with.
Yeah, the fact is, you know, if you have a family and a demanding job, you do not need another 5 things on your to-do list, right?
Right, yeah.
Great chatting with you guys, as always.
Yeah, likewise.
All right, so we've covered RSUs, ESPPs, and family offices today. And if you're feeling queasy, well, that's your sign that you've outgrown your current strategy. So subscribe to the channel for more of these Tech Money Smart videos, but even better, stop procrastinating and book a free call using the link below. This has been Tech Money Smarts with Novel Wealth. We'll see you next time.